Hi everyone, Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. If you haven't subscribed yet, go ahead and click that subscribe button so you never miss a State of the Market video. Well, after last Monday's big plunge in the market, a lot of people became interested and started talking about consumer staple stocks. And that's because consumer staple stocks are considered defensive. We're talking about companies that make products like shampoo and toothpaste and energy drinks. And yes, I said energy drinks because Monster Energy is one of the companies in the Consumer Staples Index. So apparently that means during recessions, you caffeine junkies are guzzling energy drinks rather than a cup of joe. So the top three holdings in the Consumer Staples Index are Procter & Gamble, which makes things like Gillette razor blades and Old Spice and Crest toothpaste, and that makes up 16% of the index. Coca-Cola, which makes up 10%, and Pepsi, which also makes up 10%. So apparently that means we would all prefer to drink sugary drinks than keep our teeth healthy and look and smell good. So if you've been following me for even just a little while, you know that I am the dividend guy. In fact, I wrote the book on dividends. So let's take a look at some of the top yielding consumer staple stocks and see if they belong in your portfolio. The three highest yielding consumer staple stocks are all tobacco stocks. Imperial Brands, ticker symbol IMBBY, British American Tobacco, ticker symbol BTI, and Altria Group, ticker MO. So let's just look at the highest yielder, which is Imperial Brands, based in the UK. Over the past 12 months, it paid $1.88 per share in dividends, which comes out to an 8.8% yield. Now, it's the maker of Winston and Cool cigarettes and Blue e-cigarettes. Love tobacco or hate it, it's pretty recession-proof. Last year, Imperial Brands generated about $4.5 billion in free cash flow while paying out about half that amount in dividends. Now, it has about $13 billion in debt against $1 billion in cash, but with so much cash flow, it's really not a concern. Now, earnings are projected to grow 6% a year. So if you don't mind owning a tobacco stock, smoke them if you got them. This 8.8% yield looks pretty solid. Now, B&G Foods is next, ticker symbol BGS, which got its start in 1889 when the founders Joseph Bloch and Julius Guggenheimer began selling pickles in the streets of Manhattan. Now, Bloch and Guggenheimer must have made a mean pickle because the company grew to more than 50 brands, including cream of wheat, which my family makes fun of me for because I like it, but my grandmother used to make it for me, so it reminds me of her. Is that really so wrong? Now, B&G also makes Ortega taco shells, which does not remind me of my grandmother at all, and Green Giant frozen foods. Green Giant. Now, the company pays a 47.5-cent per share quarterly dividend, which comes out to a nice 6% yield. Now, remember, B&G is coming off a year where most people were eating at home and chowing down bowls of cream of wheat like you can't believe. So their finances greatly benefited. Now, after 3 years of pretty flat revenue, sales jumped last year to $2 billion from $1.7 billion. Free cash flow spiked to $255 million while paying out $122 million in dividends. The year before, though, free cash flow was only $4 million. In 2018, it was $168 million, so it's been all over the place. This year, revenue is forecast to grow another 4%, and free cash flow is also projected to increase. Apparently, I'm not the only one who enjoys a piping hot bowl of cream of wheat. The stock price has varied between $10 and $47 over the past 3 years, but in total, it has gone absolutely nowhere. Now, while that 6% yield is attractive, to get some price appreciation, we're going to have to be confident that the company is going to be able to grow sales. And I mean, there's only so many frozen vegetables and bowls of cream of wheat that I can eat. All right, the last stock we are going to look at is ALCO, ticker symbol ALCO. Now, this is a microcap stock with just $254 million market cap and average trading volume of just 51,000 shares. The Fort Myers-based Florida company owns 84,000 acres of land that is used for growing citrus, mostly oranges. Now, it just boosted its quarterly dividend significantly to 50 cents per share from 18 cents. That's a 177% increase, and now that equals a 5.6% yield. Sales and cash flow were down sharply in 2020 due to lower citrus prices and lower production, but things have turned around in 2021. Citrus prices have rebounded sharply, up nearly 30% over the last year. Now, through the first 6 months of fiscal 2021, which ends in September, the orange grower generated $15 million in free cash flow while paying out just $2 million in dividends. So even last year, when things were tough, it generated a little more free cash flow than it paid in dividends. So management treats shareholders right and shares the wealth when things are going well. Now, Lewis Winthorpe and Billy Ray Valentine might have beaten me to the orange crop report because I have no idea where orange and citrus prices are going. That being said, if you're bullish on agriculture or on consumer staples, this one might be one to consider, especially considering that juicy dividend. Oh, come on, I had to. It was right there. So there are some top yielding consumer staples companies. What are some of your favorites? Leave the ticker symbols or the company name in the comments section. And be sure to check out my free e-letter, Wealthy Retirement, for income and wealth building ideas all week long. Just click on that link below. Thanks for watching. I'm Mark Lichtenfeld. I'll see you next time on State of the Market.